From the morning reading, SPY, QQQ, pause, stay above Monday's S1, Netflix breakouts, QRVO bounces, oil falls, three sectors moved higher on Tuesday. XLV, XLY, and XLK were the strongest sectors, while XLU was the weakest sector. Breadth weakened as decliners led advancers 1.71 to 1 on the New York Stock Exchange and 1.16 to 1 on the NASDAQ. Earnings scorecard. Of the 463 companies that have reported earnings to date for Q3 2015, 74% have reported earnings above the mean estimate, and 45 have reported sales above the mean estimate. Earnings growth. For Q3 2015, the blended earnings decline is minus 1.8%. If the index reports a decline in earnings for Q3, it will mark the first back-to-back quarters of earnings declines since 2009. Earnings revisions. On September 30th, the estimated earnings decline for Q3 was minus 5.1%. 8 sectors had higher growth rates today compared to September 30th due to upside earnings surprises, led by healthcare and the energy sectors. Earnings guidance. For Q4 2015, 63 companies have issued negative EPS guidance and 21 companies have issued positive EPS guidance. Valuation. The 12-month forward PE ratio is 16.1. This PE ratio is based on Thursday's closing price, 2045.97, and forward 12-month EPS estimate, 126.88. It's important to note that the energy sector is projected to be the largest contributor to the estimated earnings and revenue declines for the fourth quarter and for all of 2015. For Q4 2015, the estimated earnings decline for the energy sector is minus 64.3%, while the estimated revenue decline is minus 34.2%. For year 2015, the estimated earnings decline is minus 58.5%, while the estimated revenue decline is minus 34.4%. If the energy sector is excluded from the growth calculations for Q4 2015, the estimated earnings growth rate for the quarter would be a positive 1.6%, and the estimated revenue growth rate would be a positive 1.2%. If the energy sector is excluded from the growth calculations for year 2015, the estimated earnings growth rate would be 6.9%, and the estimated revenue growth rate would be 1.9%. Looking ahead for the next year, analysts expect earnings and revenue growth for all 4 quarters and for the full year as the year-over-year comparisons in the energy sector become more favorable for year 2016. And also in the commodities, optimism on copper has dropped to a 14-year low. The optimism index has fallen to 18, only the third time since late 2001 that it had dropped below 20. The others were in late January of 2009 and late June 2013, after which it rallied both times for at least the next 2 months. This is also the second week in more than 10 years that not a single user of Bloomberg was bullish on the metal. The other was in late September 2009. It hasn't helped that copper has declined 9 of the last 10 days, with the sole gain being mere pennies. In nearly 30 years of futures trading, it has never before seen this kind of persistent selling pressure. You might recall we also mentioned a similar stat with gold recently, where it had run something like 15 out of 18 trading days also down. And then also to go back to those earnings statistics, it's very important when you listen to statistics, especially from the talking heads at CNBC and stuff like that, when they talk about kind of the global numbers, to remember that sometimes you have a particular sector which is totally out of character from the rest of the sectors and could be grossly distorting those overall numbers. And that would seem to be the case right now, where the energy sector, though a very important sector, is going in an entirely different direction than many of the other sectors. So earnings growth, revisions, guidance, valuations, in those other sectors looks very, very different than it does for the earnings of that energy sector. So important to always separate those out. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I'll provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 7:23 a.m. Central Time, and I am recording this in preparation for the market day of November the 18th, 2015. Full disclaimers at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So hopefully you were able to keep up with the gist of all those numbers. It's always hard to follow numbers, a lot of numbers in a verbal discourse. But bottom line, the takeaways is what you want to focus on. And while earnings certainly for the broad market don't look glorious, they certainly look to have a very different story when you separate out the energy complex from all the other numbers. Let's go ahead and dive into our morning report. And you can see that it's been pretty quiet overnight, not unsurprising given that we have FOMC minutes this afternoon. Indeed, that will probably impact the market this morning. Might have a relatively busy first hour and then go relatively quiet into the FOMC minutes release, which is at 2 o'clock Eastern time. Now, that doesn't always happen, but that's the usual pattern. Thus far, it seems to be setting up for that, with all four broad market indices just barely over scratch. Crude oil, and note that crude oil has rolled over. It's now the important contract is the CLF16. So it has rolled to the January contract with the bulk of the volume on January. But anyhow, it's up 1.41%. Euro is up 0.19%. Bonds are at scratch, as is gold. In terms of overseas action, China is also at scratch. Hong Kong up over 1%, as is Japan, about 1.2%. Germany, big night. Germany is up almost 2%. United Kingdom is up 1.8%. We take particular note of what Germany does. That often leads our market when the cash market opens. In terms of macroeconomic reports for today, you have FOMC member Lockhart speaking, building permits, housing starts, the usual crude oil inventory, and then the big one for the day, the FOMC meeting minutes. In terms of tomorrow, we have in the United States the weekly unemployment claims, Philly Fed manufacturing, nat gas storage, and you also have FOMC member Lockhart speaking. I knew there was one of the FOMC members down there. In terms of current volatility conditions, note that we had no standard deviation moves put in by any of the markets yesterday. So after having a series of about 4 out of 6 trading days with a standard deviation move one direction or another, yesterday was much calmer. And we'll go to the charts here in just a second. Short-term VIX is 17.02. Skew remains elevated. IV percentiles running for a 26 on the S&P 500s. The 25 in the Russell, 20 on NASDAQ, 28 on the Dow. Let's take a look at the charts. In terms of SPX, setting up for a particularly ugly combination here. We had, of course, the big pullback, and it's big in relative terms in that this amount of pullback in a normal kind of market would seem to be pretty big and scary, but compared to the 250 odd points it had run up without a pullback, it was only a 38% fib retracement. So that it was a big pullback, and yet also we have to keep it in perspective. That was stopped by this big bullish engulfing candle, but then yesterday's candle is setting us up for another reversal pattern. If that happens, that would be very, very bad news for the bulls. We'll have to see where today goes, but we need to break through, and there's a some key moving average lines that are coming through just above this. If you draw a diagonal resistance area, we need to close above that diagonal resistance. And while this price action certainly went above that diagonal, not getting a close above that diagonal resistance was not a very good sign for a real breakout. We need to get a breakout above that area and be able to take this back to the former high, at least swing high, if not the all-time highs. If this fails today and we roll over, we'll have a 3-candle combination, which would be a rather ominous combination, and that would increase the probabilities that we're going back not just to here this time, but probably back down to the 1994 and the SPX levels. So kind of keep that in mind. This is a kind of an important day. Frankly, probably won't know what's going to happen with this day until the FOMC minutes come out, and that new information will probably dictate what happens into the close and just what kind of candle we get for today. In terms of the other markets, the Dow, very similar profile, though a positive candle. It's a doji, so totally indecision, and dojis need confirmation. So we don't really know anything yet other than indecision at that point. Again, a failed diagonal breakout. In terms of the NASDAQ, very much like the SPX, again, a failed diagonal breakout. And then the Russell, again, a failed diagonal breakout. So not good. So we're going to have to wait to see what happens with the action today. But this is not our favorite thing to see if we want to be bullish on the market. In terms of volatility, we continue to be relatively elevated and up out of the normal bull market range for volatility. We're up over 18, while certainly we have subsided from this action that started popping into the low 20s. This is still relatively high. Now that can present some opportunities for aggressive, more experienced traders to sell some premium, and yet at the same time, if you are a bull, you should take that as something of a warning sign. So that should be enough on that. Let's go ahead and go to the regular daily report. In terms of if we get that diagonal breakout, this will flip to probably phase 2, but right now it's still in short term, the break of diagonal and horizontal support, relatively bearish, and something of a warning. IBD status remains in a warning status as well, uptrend under pressure, and you recall that we've had 9 failed confirmed uptrend signals so far for 2015. Accumulation distribution, the S&P score is a C, the NASDAQ a C minus, both of those in the warning stage. GMI index did improve 1 notch to a 4 out of 6. The buy signal has been in place since 1019, though that author remains in cash, though has started to enter some positions very, very carefully. Primary market condition remains neutral bear, so something of a warning there as well. Decision point scoreboards, no changes here, so we have mixed signals on the short term, relatively strong on the intermediate term, and mixed signals on the long term. When you put all this together, these mechanical signals put together come up with a very much a transition market, so we can't really tell from here whether the market is really going to go in the intermediate term to the long side or the bear side. That should be something of a warning for you. In terms of the intermediate term market posture, it is bearish with an upslope sentiment, so it's also giving mixed signals. And you would expect with mixed signals that the position sizing opinion would be relatively conservative. Indeed, both systems are currently signaling for a reduced position size of roughly 50%. In terms of that intermediate term market posture, you can see all 4 indices are in the bearish camp with falling scores. If the Russell drops below a 50, that will go to very bearish. So be careful that you're not being more bullish than you really should be right now. In terms of hedge warning status, the current level is level 1, so an elevated risk condition. This is somewhat elevated. It's a yellow light. It's caution. And again, that is a call that Not necessarily that the market's going to go down or go down by a certain degree, but that the market is at a point of some elevated risk conditions, and that should be something of a warning to you. We went over earlier in the week, and if you missed the session, Monday morning's YouTube video went over some of the steps that you might take in a level 1 condition to review and protect your portfolio. So you might want to bounce back and listen to that. All the recordings are on our YouTube channel. It's very easy to subscribe to that and get alerts when these channel postings take place. Bottom line is that if you listen to this each day, I'm not going to say that every day is fraught with lots of new information, but you'll, as we review these subtle changes that often take place from one day to another, you'll have a very, very good feeling for where the market posture is, some market timing elements, and certainly a much better understanding as to the relative level of risk that is present in the current market. And that can be very helpful to any kind of trader or investor, no matter what time frame you are on. In terms of the particulars for the volatility metrics, you notice that we've had a couple actually ebb off. We're in okay status in both the cross relationship and the short to intermediate term status. So those have both kind of come off in recent days. We still do have the warning about the VIX futures being up over 18. This distribution day count is still relatively high and in warning stage for both the S&P and the NASDAQ. NASDAQ, recall, also had a very kind of ominous 3-day cluster of distribution days last week. VIX phase has been increasing, skew still elevated, running about a 12% probability, or said another way, about a 7-fold increase over normal for a 2-standard move to occur in the next 30 days. In terms of some of the other warnings, New York Stock Exchange new highs, new lows, not actually level of warning. I did go ahead and leave this colored red just to draw attention that the ratio of new lows was about 3 times higher than new highs. So certainly not a sign for the bulls. Intermarket risk aversion indicators, 3 out of the 5 are solidly at risk off situations. In terms of special opinions, no real change from yesterday, but continue, and really as you read these, and hit the pause button if you need more time than I stay here. I'm not going to go through these by detail since there are not any changes today, and we're already 17 minutes into the video. But bottom line is that remain defensive, and there's a lot of different ways that I speak to about how to become both engaged in the market as is appropriate to your level of trading experience, and yet at the same time take defensive postures. Sector market posture for today, if you see short to intermediate term, pretty ugly, only materials showing up, stances, and transportation, that's always worrisome when it is a particularly weak sector. Also utilities, as might be expected given the pressures from interest rate changes, and retail. We've had some important earnings coming out of retail of late, and while there were some surprises to the upside and some good reports, overall the sector still remains quite weak. In terms of percent change, you note that yesterday was pretty negative across most of the sectors. Healthcare and telecommunications did have positive days, so kind of keep that in mind. There are pockets, but you see this is pretty scrambled right now. 1 day, 5 day, 1 month, 3 month. It's very, very difficult to find any kind of consistency in this market. In terms of the information for today, I think that's probably enough. As always, if you find that this is helpful to your trading, the way you can acknowledge that and show your appreciation is to like us on YouTube, to subscribe to us on the YouTube channel. We continue to see our subscriptions there drive up. That's a free subscription, but we take note of these acknowledgments as encouragement to continue to provide this free information to you each morning. Retweet us to your Twitter followers, to your StockTwit followers, etc. direct email support at falconglobaltraders.com. As always, I'll pick out one of these special offerings, something to kind of keep in mind. We are putting together a covered call mastery course. If you think you might have an interest in this, just send me an email and I'll put you on a list of people that want to get more details when that becomes available. I expect that course will roll out sometime in early 2016. Understand that you can find out basic information about the cover call strategy, the most simple option strategy out there in a lot of places. But this is going to be far, far deeper. By the time you get finished with this, you will have a complete trading plan with all the system rules and have a deep understanding of every element of the screening process, the choosing the covered calls, and then most importantly, how to manage those covered calls. Also, people who take this course will also have access to the full membership program with Falcon Global, with our live trading chat room during the course of this course. So a lot of different things will be coming together on that. But if you have an interest, just send an email to Stephen@falconglobaltraders.com and I'll be sure to put you on that list for more details when they become available. Disclaimers as always, hit the pause button if you need more time to review. And we'll see you back here on tomorrow morning for the Falcon Global Market Preview. Good trading.